Good afternoon, everyone, and welcome back. I'm Robyn Polansky Morrison, and I'm the moderator for this third and final session, completing the first day of the JLens Jewish Impact Investing Summit. On behalf of myself and my panelists, we hope that this conference today finds you in good health, keeping safe, and managing well. And a huge thank you to Julie, Rabbi Siegel, and the entire JLens team for your tireless work to produce this important content, and specifically for me, for the opportunity to lead this discussion of grants versus loans and how Jewish organizations are driving greater impact with all different types of capital. So before we get started, a few housekeeping comments. As Rabbi Siegel mentioned, tomorrow, day 2 of the Impact Investing Summit, there's a separate link for viewing the sessions that you should have received in an email. If not, email Rabbi Siegel directly. And importantly, the content and the videos of the summit will be available online to review if you missed a session and would like to share sessions with your peers, your community member, and the like. It's really good and important to share it around. And lastly, we welcome questions during our discussion. We'll try to leave time at the end. Please use the question and answer box at the bottom of your screen to submit your questions. So let's go get to it. So setting the stage, we can all agree that the collective Jewish community has thought extensively about our philanthropic giving to mission-focused organization and executed extensive giving for many, many, many years, decades, centuries even. That said, there remains incredibly tremendous potential for our community's endowments and investment capital to further the work of our organizations. We have to get creative. We have to educate. We have to support organizations that are modeling ways to further the impact of capital. In the next 45, 50 minutes or so, we will explore several innovative efforts to leverage investment capital to support our Jewish organization. So let's dig right into our panelists. Let's start with you, Sam Marks, a wonderful and effective leader in our community. Sam is the CEO of FJC, the Foundation of Philanthropic Funds, which offers services including donor-advised funds and fiscal sponsorships. FJC has been running a loan fund for nonprofits since long before the current crisis. Sam, how did this fund come about? Could you tell us about these loans and maybe share an example? What are the typical needs of organizations that you're seeking to meet, and what's the duration and interest rate? A big question to start off.
Yes. Thank you, Robyn, and thanks to JLens for leading this conversation, this important conversation. Many of you may be wondering what's the connection between donor-advised funds and lending, and we'll get into some of the mechanics of that, but let me just lay out the basics of our lending program and what we do. We lend to the nonprofit sector. We're very attuned to the needs of nonprofits, and we can be very fast about getting loan capital out, fast, flexible, and nimble in getting to yes. The loans can be anywhere from the smallest $10,000 up to $4 million. We can even go larger with a co-lender. And we're typically bridging some other commitment, a city or state contract receivable, a capital grant. We're typically looking for some kind of firm takeout source. So a lot of nonprofits, they have city contracts to do work in the community, but they can't meet payroll with a contract. They can only, pay the bills with cash. And that's where we come in. Government is often very slow to pay for various reasons. And a lot of capital grants are only available on a reimbursement basis. You have to pay for things in the project before you have the money in hand, and that's where we come in to bridge those types of commitments. We usually go out, we can go out a maximum of 5 years, and our interest rates are the same for all of our loans. It's a floating prime plus 3%, which right now is about 6.25%. The Fed funds rate is pretty low right now. And we make loans to all kinds of organizations, arts organizations, social services, affordable housing, you name it. We've advanced over 280 million in loans to over 200 nonprofit organizations. One example is OHEL Children's Home and Family Services. They are a provider of social services to folks with developmental disabilities. They run group homes. And they received a grant from the New York City Department of Design and Construction for $2.4 million to purchase and renovate a group home for developmentally disabled individuals. And we were able to bridge that contract with a $1.2 million loan to OHEL.
That's fantastic. Have you seen any trends in the loan applications over the last couple of years?
I think we've just seen enormous need, particularly on the side of bridging city and state contracts. I think that's what drives a lot of folks in our direction. They have money coming in, but they just have that timing gap. Yeah, it's been all over the map, all kinds of nonprofits. I think we're a little bit of a best kept secret. The people who know about us come to us frequently. So we're even more trying to get the word out and just let people know, we're open for business.
I'm glad you said that because it is a very good kept secret. So hopefully today we can give a little bit of a window into the great work that you're doing. So thank you for that. So Alex Roth-Kahn, my second panelist, is the managing director of the caring department at UJA-Federation of New York. You are a resourceful and inspirational leader, Alex, in our community. Thank you so much. So UJA made a concerted effort beginning last year, maybe even the year before that, to consider impact investing as part of the overall grant portfolio. With the team, you sent out a request for conversations. Could you describe this process and your search for ways to either make impact investings or impact allocations, or award grants to organizations that recycle capital or create organizational stability, looking at things a little bit differently than the traditional grant process?
Thanks, Robyn. It's great to be with everyone this afternoon. So before I answer the question fully, it's really important to note, as Robyn noted, I represent the allocating arm of UJA-Federation, not the investment side. And in truth, we are pretty siloed. So it's important to note that we are not doing traditional impact investing in which an organization invests money from their endowment or other funds in order to achieve a double bottom line, social good, and a return. Rather, on the planning side and the allocating side of UJA-Federation, we created our own definition of how we can be active in this space, which we call impact allocations. That's our definition. We're now allowing our grant-making committees, which typically fund and renew projects for 3 to 5 years or so, the ability to either make loans, which is a new concept for us in a grant-making division, or to seek grant opportunities in social businesses so that a one-time allocation, opposed to a renewal for 3 to 5 years, is invested into a business model that is able to generate revenue, and the program after a one-time allocation becomes self-sustaining. In reality, in this paradigm, our one-time grant almost becomes recycled year after year. So as Robyn noted, we sent out a call for conversations to social businesses last summer. We sent out a second call for conversations last winter. All went to organizations with a 501c3 status or a for-profit company with a subsidiary. And we were very overwhelmed positively with the amount of interest there was in the field. We were able to then present the organizations that came forward to us to understand if the content of their work, of the projects that they were spearheading, were aligned at the mission level with our historic grant-making committees. This is actually where we came across some challenges, and happy to talk through that perhaps in the next question or later on in the panel.
I was just going to say, so this is a pretty unique approach, and one of the challenges that we've identified at UJA is that grantees typically that we work with are used to that grantee-grantor relationship and operate in nonprofit space, right? Many nonprofit models don't recycle capital, and social business purposes, which do have earned revenue models, may not be in UJ's orbit, and we might not know about them, which is why we did the call for conversation. But can you share a little bit more about that challenge? I think from even an internal and an external perspective, right? Shifting ideas, shifting thought processes.
Yeah, so as I mentioned, when we sent out the first call for conversations, to our surprise, many of the organizations that came back to us eager to have a discussion with UJA were organizations that were doing extraordinary work, to promote employment for formerly incarcerated individuals. Now, I'm not quite sure. I don't think any of us to this day are entirely sure of why we were inundated with requests of this particular nature and not so many other types of social businesses. But we experienced a bit of a dilemma in that the leadership and the staff, Robyn included, and myself, were very amazed by the options in front of us. We weren't able to find a thematic committee at UJA that had raised its hand and said, this is an issue where we want to invest our philanthropic dollars. So we struggled to align the product in the field with where we were headed internally. We've made some excellent referrals to the organizations that did present themselves to us, and we hope that they're on a path towards seeking the needed and desired funds, but we were unable to, through our funds, make their requests possible. So what is very clear to us at this point is that within the orbit of the UJA-Federation core partner agencies, as Robyn mentioned, many very traditional human service agencies and community centers that have a human service lens, they require far more training and an opportunity to engage in learning as to how their client populations can actually be put to work in a way that will ultimately generate some form of revenue, and for us could be considered an impact allocation. The field, at least the field in direct proximity to UJA, isn't ready for that yet. So we weren't able to move as effectively on our ideas as we had aspired, but we're not giving up. And we're planning to put forward a series of trainings to organizations that are close to us so that they can learn these skills.
I think that's an important point, right? This is not going to happen overnight, all of these concepts and ideas, and it's going to be a little bit of trial and tribulation. Some organizations like SAM's have been successful in utilizing capital in strong ways for a long time, but going to a more traditional model, it's going to take a lot of hard work, a lot of education, and a lot of effort. So thanks for explaining that process to us. So I'm going to turn to Rabbi David Rosenn, a thoughtful and impactful leader who's the executive director of the Hebrew Free Loan Society, which offers vital loans to low-income New Yorkers. Traditionally, you've done that through raising philanthropy, but 2 years ago, you explored being the recipient of impact investment capital from a foundation that you could loan out and then repay the foundation. Can you tell us what motivated the organization to pursue this kind of capital?
Sure, and thank you. I want to add my thanks to JLens for hosting this panel and raising this set of issues. For us, it was really a matter of wanting to have more impact than we were able to by simply raising philanthropic dollars. At the time that I started a Hebrew Free Loan Society around 5 years ago, we were lending around $8.5 million a year. We knew that this was much, much less than the need, and we started to try to reach more people, but we knew we would need more capital for that. We, this year, will lend about $20 million, and so that's an average increase of almost $2.5 million a year. We raise through philanthropic gifts about $1 million a year. And that is over and above our operating budget. Our operating budget is only $2 million. So there's another 50% that we raise in order to make more loans. But that was not nearly enough. So we started to ask where we might be able to access capital for making loans that doesn't have to come through the gifts channel. And it was clear to us that there is a lot of philanthropic capital that is held in the form of cash in endowments of various sorts. And so our first asks were to foundations that funded us for operations to discuss with them, would you like to use the other side of your balance sheet for more impact? Make us a loan at 0%. We will guarantee 100% capital preservation, which we can do because our lending, this is all pre-pandemic, so I don't know what the future holds, but our lending is typically 99.9% return to us. And so we felt comfortable saying to any lender to us, we can guarantee that you will get all of your money back, but because we're lending at 0, we'd like you to lend to us at 0. And so that was the beginning conversations with some foundations. And we went on from there to actually have a very fruitful conversation with the Jewish Communal Fund about the same option for account holders at donor advised funds.
Was that relationship with the Jewish Communal Fund sort of a no-brainer? Is that was that a workable?
I wouldn't say it was a no-brainer. It seemed like a very good idea, but when you try to get any set of institutions to partner on a new idea, it's always challenging. I will say that they were extraordinarily receptive. I approached Sue Dickman, the head of the Jewish Communal Fund. She actually said to me, David, we're in the middle of a strategic planning process. Can you wait for us to sort through all of our issues? But this is something that we're actually talking about, which is how to make impact investing available to account holders at the donor advised fund. And I said, sure, I'm happy to wait. Hope it's not too long. And, in about half a year, we got back into a conversation which fairly quickly led to a program where people who have accounts at the Jewish Communal Fund can assign to us, actually it's assigned to something which we call the Social Impact Loan Fund, some amount of money, which comes to the Hebrew Free Loan Society. We use it for 2 years, and then we will either return it to the account, or people can renew it for another 2 years, or they can make some of it a donation, or we haven't really gotten to the maturity of any of those loans yet. But it was a way to increase the impact that people could have with the dollars that were in their donor advised fund beyond their grant making. And I'm really happy to say that this model has also spread to the West Coast. My counterpart at the Hebrew Free Loan Association in San Francisco recently just mobilized around $5 million in capital from the endowment fund at the Jewish-Federation of San Francisco. So this, I think, has a lot of potential to increase the impact that donor advised funds are able to have in the philanthropic space.
I think that's a really important story to tell, David. I know it was a little different than what we had prepared to chat about, but there is a lot of challenge in some of these programs, and creating it's going to take time, it's going to take effort, it's going to take patience. So I appreciate the candor. The other thing is there's also a number of concerns with receiving impact investing capital, right? One of the common fears among many organizations wanting to receive both grants and investments is the fear that the investments will actually sort of cannibalize the grants, and funders will end up expecting their money back. Receiving the impact investment is also a greater administrative burden than a grant. So how do you judge whether this is a worthwhile endeavor, and where does that balance come in?
Well, I would say that for us, we have a $20 million loan portfolio, and we have a $2 million operating budget. So the question is not, will your raising of loan capital cannibalize your operating budget contributions? We are hoping that the capital that we bring in through the loan channel will be actually many times greater than the capital that the funds we have to raise every year for operations is. So for us, I think the assumption is we're going to be out there doing both at the same time. We started this with foundations who give us operating grants and asked, would you like to add on to your impact? Not a single one of those foundations has ever suggested to us, oh, we'd like to shift over entirely to the channel of just lending you money, and we don't want to support you anymore with grants. I don't think that's the frame. We have not had so much success convincing lenders who came in through the channel of impact investment through a loan to then add on to that an operating grant. So, you know, we are careful to try to, I have like an ABC, right? My A ask is, can you please give us money? And then if the answer to that is no, my B ask is, could you please lend us money? I have a C ask, but that's more complicated. In any event, whoops, sorry about that. We think that the bigger danger for the cannibalization comes in actually at the smaller donation level, okay, right? Because there are a lot of crowdfunding ideas around lending, and if we made available to everybody who we interact with, asking them to support our work, the option of supporting it by giving us loan capital or by giving us an operating grant, I think that would be challenging for us. And I think a lot of people would opt for, you know, giving a loan through us to some needy borrower rather than supporting us as an institution to be able to mobilize all the loan capital that we mobilize every year. So I'm not denying that there is an issue there, but for us, I think we've been able to handle it in a way with pretty sophisticated philanthropic partners, foundations, and donor advised funds, so that the two channels don't wind up at cross purposes.
Got it. Thank you. So let me shift over to Sam again and talk about your organization offers donor advised funds, or as the Jewish community affectionately calls, and just all the acronyms, DAFs. You've shared with us separately that over 60% of your DAF holders are invested in your agency loan fund. Can you tell us about the loan fund and what has been compelling about this fund?
Sure, and just one point of clarification: $60 million in assets relative to our $300 million in assets. It wasn't exactly 60%, but it's a very popular impact investing option. I mentioned the loans that we make to nonprofits. And what's interesting about FJC, you know, we're a foundation of primarily of donor advised funds. We've got, you know, about 300 million assets under management across 1,000 accounts. So you can think about it like we have like 1,000 little mini foundations under our umbrella. And as I think most folks on the call know, when you set up a donor advised fund or a DAF account, you make a donation into the account, and you're able to recommend two things. One, how those dollars are invested for growth, kind of like a little mini endowment. And secondly, when and where those grants are turned into grants to nonprofits from the account. So getting to sort of the endowment side of things, our agency loan fund, which is the pool of capital that makes these loans to nonprofits, that's one of the options we offer up to our donors for where they can invest their money. They can put it in fairly traditional types of instruments like stocks and bonds and money market. We even let some of our larger donors bring alternative investments, hedge funds, or other type of investments onto the platform. And our donors can think about their tolerance for risk and return across all those choices. It's almost like when you have a 401k account and you kind of have the options. But our impact investing option is our agency loan fund, and that's the pool of funds that we lend out to our nonprofit organizations. And I think it's compelling for two reasons. One is on the impact side, while our donors' funds are growing in their accounts, they can be put out to work as bridge loans and out in the community in support of mission. But the second is that the agency loan fund as an investment option is also pretty attractive. It's got a pretty decent return on an annual basis. Our donors who choose that option typically earn between 4.5% to 5.5% annually. So it's having a pretty good return while it's making impact, but it's also pretty low risk. We mitigate risk, one, by making really good loans that very rarely go bad. We know our customers, we underwrite them, we're flexible about how we get to yes, but we make really good loans. And second is that we have credit enhancement in the picture. There's a private foundation that we have a good relationship with that's agreed to put some credit enhancement on the portfolio. So even if one loan goes bad, and that's very rare that it does, the risk to donors is extremely remote. So, for 4.5 to 5.5% return, very low risk, that's looking pretty good, particularly in today's world, as the stock market is very volatile. No donor historically at FJC has ever lost principal in their agency loan fund account. And our borrowers continue to pay interest and principal, so the asset quality is there. It's a pretty compelling story.
Do you find that as people come aboard and look into the various options that you guys have, there's a bit of an education process, or are most people that are coming to you sort of know that they want to do more with their assets?
I mean, I think the process of opening the account, we try to make it as easy as possible. So we lay out the options and let people pick off the menu. I think that should we do more education with our donors about different opportunities, their eyes could be open to other kinds of impact investment options. I'm really compelled by David's story about how Hebrew Free Loan Society was able to work with another DAF platform to get more donors to consider putting their money out as kind of 0% interest loans. We see that from time to time among our donors as well. They know that we do loans, and that they're interested in making customized loans to nonprofits of their choice. So we just made a 0% interest loan to a nonprofit on Long Island, a domestic violence organization. This was not out of our core agency loan fund product, but it was this individual DAF holder's interest in making that loan. And we helped them understand the organization, look at the financials, we documented the loan, we closed the loan. And I would love to see more of our DAF account holders using their philanthropic dollars in that way. I think there is more education we could do, and that's why these kinds of forums are so important.
I was just going to say, how do we get people to do that more? And really, it's through these discussions. So thank you for that. So going back to David, you have begun, as Sam was also saying, working with DEF Capital. How do you make the case to DAF holders to make a 0% interest loan? I've heard that you've compared a loan at Hebrew Free Loan Society to a money market fund. So tell me what's behind that comparison.
Okay. I think there are a lot of different ways that people can think about the money that is in their donor advised fund. One of the ways that you can think about it is, I've given this money to philanthropy, and it's just a matter of timing about how I put it out. And so in that case, you ought to be open to all kinds of asks that have the philanthropic flavor in them.
Okay.
I think you can also think about the money that's in your donor advised fund account as a portfolio that you hope to grow over time so that you can do more with your philanthropy. And then you have more of an investment mind, and you worry about the return on investment of the funds that are in your donor advised portfolio. So what we tend to say is, whichever of these attitudes that you take, usually your portfolio is diversified. You're going to hold some riskier investments so you get a higher return. You're going to hold some safe investments so you get a steady return. And we're interested in talking with you about the safe investment part of your portfolio, the cash and cash equivalents that you have there. You should be indifferent to where you shouldn't be indifferent to where they are. You should want them to be in a place where they not only are performing the function of de-risking your portfolio, but they're also doing good in the world. So if you lend them to us at 0, you still get the same return as cash, but you will have an enormous social impact over the time that the money's with us. And we see that as a plus, because if you're going to hold cash anyway, then you might as well hold it in institutions of the community that can mobilize it for the good.
I like that. Thank you. So since we're here and we're under a Jewish lens, let's dig in a little deeper to that complex issue of interest in lending in the Jewish context. So Jewish tradition, all the way back to the Torah, praises giving loans to our fellow community members without interest. My Morr Brenda is not going to appreciate, but Rabbi, is that the way you pronounce it? Okay.
You got it.
But zero interest loans are a small segment of the entire impact investing ecosystem. So in your opinion, when is it appropriate to seek a financial return, and when is it appropriate to give a zero interest loan?
Okay, let's start from the premise that every impact investor has the two kinds of return that Alex mentioned in mind, right? You want a social return and you want a financial return. But in both cases, what's similar about an investment is that the investor retains ownership of the asset, right? You are going to get the principal back. And so the question is, what's going on with the return? How much return do I have to have? I would say from a Jewish perspective, if you are lending to someone in financial distress, that should trigger in you a response of solidarity and compassion, not a response of what will my return on this investment be when I lend this person money. So when giving loans to people in financial distress, you should not be seeking a financial return. However, for centuries, Jews have figured out how to lend at interest or do something that is structured in a way that looks a lot like lending at interest, but is okay according to Jewish law, because everybody understands that we have to exist in the world of business, and it's okay to expect a return on an investment, even if it comes in the form of something that looks a lot like interest. So the question is, for impact investments, is it more like a business deal, or is it more like a way of helping somebody in financial distress? So for instance, are you lending to the JCC to build a pool so that they can then charge people to come to the pool, and then it's a self-sustaining model for the JCC? Or are you giving capital to a Hebrew Free Loan Society, which we will do is straight on, take that money and lend it out to lower income people who are in financial distress? I would say that the latter is a circumstance in which it's Jewishly problematic to look for a financial return. And the former, feels to me a little bit more like a business deal, and therefore kosher for structuring in a way that provides a return to the investor.
Okay. There's a lot of complexity in that. Sam, how would you answer the same question from the perspective of the agency loan fund, which does charge interest?
Right. Well, one nuance is that we're not lending to individuals in distress. We're lending to nonprofit organizations. So I feel like it does have a little bit more of a business flavor to it. I'll also say that, we are somewhat constrained by the types of capital we have as a source of capital to lend. So for the most part, we're lending capital in our donors' accounts for which we have a fiduciary responsibility. And I think we're guided more by that than by scripture in terms of our approach to the lending. We do take some comfort, though, that the interest we charge stays within the philanthropic universe and goes toward mission. So while these accounts are growing, it's not profit in the traditional sense. It's all going to grow philanthropic assets, which can then be recycled into the community and do more good.
That makes sense. So Sam, I've heard you also articulate that the percentage of assets that people would be comfortable earning a 0% return is actually quite small. Well, David, I've heard that you articulate it's bigger than we think. Can each of you elaborate on those thoughts?
Well, I'll just start and say, it's not very common that people are coming to us thinking about or pushing us to put their money out at 0%. I think to a large degree, our donors are where most of sort of more traditional institutional philanthropy was a couple of decades ago, in thinking that the purpose of the investment is to grow the account so they can do more grant making. I'm not sure that they're quite at the on the leading edge yet of where philanthropically minded investors are, but that's kind of on us to help educate and lead and identify options. And we're certainly singing from the rooftops anytime one of our donors does something particularly innovative. I mean, that's what we like to push, is to help our donors think outside the box.
Thank you.
It's a process.
For sure. David.
I would just say that when you start from almost $0 available for this sort of thing, it seems like, the amount that you haven't yet accessed is very large. I'm sure there is an upper bound to how many people would be willing to lend out their money at 0% as an impact investment. And again, I want to return to my characterization of loans at 0% as a kind of safe asset that you hold in your impact investment portfolio. So probably you have a diversified portfolio, and not all of it is going to be super safe cash-like investments. So please do, seek other kinds of return in other kinds of investment. But there is a huge amount of cash and cash equivalents held in philanthropic, just limited to philanthropic institutions or the bank accounts of philanthropic individuals. And, as we are in a environment where interest rates are almost at 0 and people are talking about negative interest rates in the United States, the ability to promise capital preservation actually turns into, even more of an attractive investment than it might otherwise be. So I think that there's a huge amount of potential for mobilizing 0% impact investments, but I don't want to exaggerate and its role in the overall impact investment field. I mean, clearly, double bottom line investments are where most of the action is going to happen. And I'm happy to fly the flag of 0% as a legitimate tool in the toolkit, but I also think that other tools need to be there, a lot of other tools.
I would tend to agree with that as well. Alex, I don't want to leave you out of this conversation, but I know there are certain parameters that we have to work with at UJA-Federation, but is there anything you want to add to this part of the conversation?
Sure. I guess I would just begin with what I offered at the beginning of the webinar, which is that I'm representing the allocating arm of UJA-Federation. I'm not representing the investment division. And in fact, our investment division is not yet prepared for this conversation. So the folks who sit around our investment table are, I suppose, considered the titans of Wall Street, and their deepest concern is to ensure that we have the grant-making dollars available on an annual basis. And if an impact allocation, which would pride itself in the social return as much as the financial return, wouldn't yield the same level of finances for UJA, it's not a decision that they're prepared to make. So once you turn the discussion over entirely to the allocating / grant making side of the house, you're by definition having a conversation about a 0 interest investment, because we're doing that off of the communal dollars that have been raised by and large for grant making.
Makes sense. So I'm going to shift the conversation again. There's a lot going on right now in the age and the new reality of the coronavirus. So the Jewish response at large to help has been absolutely breathtaking. It's been remarkable. I think Catherine Gonnerman in the first session said that fantastic things are happening, and I couldn't agree more. In talking to many communities, the funds raised and the loans being made, the children's response, everybody's getting active, everybody's getting online. It's just remarkable. It's heartening. warming. It's wonderful. More specifically, JFNA support to help many organizations as possible leverage the Paycheck Protection Loan programs. The Jewish community's recent launch of the Jewish Community Response and Impact Fund collaboration, which is an $80 million in loans and grants. There was just recently a bunch of loans made to the Jewish summer camp programs. I mean, the list goes on and on and on. It's remarkable, as I keep saying. So Alex, so since March, UJA has stepped up with some immediate and emergency impact investing in the form of loans, as I keep saying, partnering with David and the Hebrew Free Loan Society, among others. Could you tell us a little bit more about some of those initiatives?
Sure. So as you noted, we have, I would say, since the earliest days of COVID-19, recognized that not only is the client base deeply in trouble, the most vulnerable and normative populations that are struggling immensely, but the institutional world is also in trouble. So the degree to which human service agencies or community centers that had both a service delivery agenda as well as a fee-for-service model have an inability right now to galvanize the revenue that they historically had, making their business model work. So from the start, in addition to providing support to individuals in need, we have worked in a very strategic way with Hebrew Free Loan Society. We opened up a $20 million loan fund so that organizations who are awaiting the payment on a government contract are able to receive a loan in the intermediate period. In Israel, we created a loan fund. Robyn, you've been instrumental in this, to at the tune of $600,000, almost actually close to $700,000, to ensure that small businesses on the geo and social periphery of the country were able to continue delivering their product to the community when they weren't seeing as many individuals come through their doors. We're also considering right now a loan program for PPE, personal protective equipment, that would enable organizations to receive a loan before their FEMA reimbursement comes in. And I also think that it's worthwhile to note that prior to COVID, when many of us were talking about increased anti-Semitism and a world in which security was the most dominant concern, we created a loan program with the Hebrew Free Loan Society to ensure that organizations who were awaiting a non-for-profit security grant were also able to receive those funds before the government paid it out. And the beauty behind this type of lending, when the government contract is tied to the capital, is that it, I believe, really reflects an optimal public-private relationship in which philanthropy is coming in to amplify and make possible all that government is actually able to do when the appropriate resources come to bear.
Thank you. Do you think that this crisis will lead to everything we've been talking about, right? A true rethinking of philanthropy in the Jewish community to create more space for impact allocations, impact investing, granting, more excitement about the loans in addition to grants? What are your thoughts for the future?
I do. I think that when you have the conversation with stewards of donor dollars and you talk to them about the sustainability of the projects that they're funding, it's much easier for people to galvanize around that than to think about getting their money back. At least that's what we found at UJA. So when you're sitting with a committee, a group of people who feel that their mandate has been to make grants, and those folks ruminate year after year, why can't this program ultimately have some form of sustainability? Why are they forever tied to our grant-making dollars? Once we've introduced the concept of either lending or funding a one-time allocation, once a business model has been presented to us that shows how a form of revenue can be woven inside of it, automatically the donor base begins to imagine a pathway towards sustainability, which excites them. And that's very, very different than a conversation in which we're asking folks to lend out opposed to the spirit of ongoing giving.
Got it. Sam or David, do you have anything to add in the spirit of that question? What do you think the future is going to hold for your organizations in terms of increased or different types of inquiries and strategies? David, do you want to go first?
Oh, okay. I think it's really hard to tell what's going to emerge from the other end of this crisis. And I think that what's remarkable is the degree to which everyone from the government to the philanthropic sector to the nonprofit sector has mobilized in ways that they are not used to mobilizing in. They are, interest-free loans are now, the biggest thing that everyone is doing. We used to be, an odd duck in the water. And now there's obviously a huge need for setting aside for the moment the very serious calculations of impact and just dealing with emergency needs and trying to make sure that you can do this fast enough and big enough so that it has the impact that it needs to have. I think it will actually take us some time to get back to a more serious conversation about impact investing, especially on the what is the social impact side, which is always the hardest. And I know there's a session tomorrow about that, so everybody should tune into that. But I think for now, it's excellent that some of these muscles have been exercised. I mean, UJA has been really remarkable in its willingness to try things out. One of the things that Alex didn't mention was that during the federal government shutdown, we partnered with UJA-Federation to make available paycheck replacement loans for federal employees who were affected by the government shutdown. I mean, this was not something that I think UJA had really done in the past, and we reached out to them, they reached back to us, we figured it out. So there are models that are being tested and explored, and I think that will move things forward. But I also think that it is going to be a long, slow recovery, and there's still going to be a lot of just emergency needs, grant making and loan making that happens. It probably will not have the rigor of the impact investment conversation pre-pandemic, but hopefully we'll get back to that eventually.
And I think a lot of the work that's being done will be a great model to say, hey, look, this actually works, right? And I agree with you, it's emergency first, but we do have to continue the conversation in some way or another. Sam, did you have anything that you wanted to add here?
I want to agree with David that we are such early days of this. It feels like we're maybe at the bottom of the first inning. It's going to be a while before we know how this is all going to play out. So much of the lending that we do is tied to bridging government commitments. Yeah, I think particularly state and local budgets are going to be playing triage in terms of cash flow just to manage their own payrolls, much less meet their contract obligations. And that's where you start to get into questions of federal policy as well. For the next $3 trillion that's coming through Congress, a major sticking point is whether federal funds are going to support state and local governments, which are required to balance their budgets, and they can't print money in the way that the federal government can. So for us, we're seeing our nonprofits really getting nervous about cash flow, but also being nervous about taking on debt when things are so uncertain. I mean, we have one capital project that came to us. It's a major capital project in the Bronx. Funding from the city has been committed. They're in construction. They've got great political support. And in normal times, you'd think, once a project is underway, they can be pretty certain that the local government is going to stand by its commitments. But now, they're coming to us for a loan, and the level of due diligence we're needing to have around formal assurances that the money's coming it's Yeah, like I said, very early days and a lot of kind of unsettling and uncertain future.
Great. I would agree with that. So as we're wrapping up our time together, I know we can go on endlessly on each of the questions that I talked about, but from a practical allocation, for those sitting on the conference today, how do you start? How do you make an investment? How do you, get a DAF? Just some practical direction. David, if you want to start a couple of wise words to get started.
I don't know if I have wise words. I can tell you that if we have done this pretty retail until we got into the conversation and the relationship with the Jewish Communal Fund. So we had conversations with individuals and with foundations about making loans to us. We quickly developed, a pretty standard loan agreement that makes it very easy. And so I would just say that if you are involved with a foundation and it holds cash, which it probably does, and you're willing to think about, are there cases where lending this and getting it back serves the same purpose of de-risking the portfolio? That is another way to really increase your impact right now without necessarily putting at risk any of the return. And in terms of the DAFs, if you're in San Francisco or you're in New York, I would go to the Jewish Communal Fund in New York or the San Francisco Jewish Community Endowment and ask about how to do some of this 0% lending through to people in the community as an account holder there. If you are interested in more systemic support of institutions, then FJC has its great program.
Great. Sam, practical ways to put money to work.
Yeah, I would just say, there is a whole industry around, community development investing, impact investing, philanthropic lending. Folks have been doing this for a long time, so don't reinvent the wheel. Find the places that are easily able to put your money to work and have an infrastructure in place to do so. That can be a community foundation, it can be a DAF sponsor like FJC or the Jewish Communal Fund, but go to where your values are aligned and where you're confident in the expertise.
Thank you. And Alex, how do people put their money to work at UJA in an impact forum?
Come get involved, just like you did, Robyn. So I want to recognize the example that Robyn symbolizes for us, because at UJA, on the allocating side, we really were not using this language, nor were we pursuing strategies aggressively or challenging ourselves internally to think about how we could do things differently, until Robyn and a few others raised their hands and said, UJA, you're missing the boat. Not only will a next generation of donors come in who are interested in these ideas and want to see UJA be able to act on them, 2, you're missing an opportunity to do more sustainable giving, and 3, you're missing a pool of recipients who would benefit from your support and who ultimately can be mission aligned. And I would add to that, you're not yet offering your own organizations, those who sit under your network, the opportunity to think about these concepts aggressively, and it's doing them a disservice. So because folks came forward, Robyn and others, and said, let's reimagine things, we've shifted our mindset, and it's just the beginning. It just takes people who want to get involved and ask questions.
All right, on that note, I'm going to say thank you so much for your time and your thoughts and your passions, David, Sam, and Alex. It's been a lot of fun to host you guys for the last hour. And to everybody out there, thank you very much for joining us today, and we look forward to seeing you tomorrow. Be well.